must be stupid to lose money investing. So all the people who are not here, they are all over there in around, right? They are the smart people, because only the stupid people need to know why you are losing money investing, right? Because you are making money, you don't need to know, right? Okay. Now, a lot of people ask me, how come your topic is called you must be stupid to lose money investing? Huh? There is some history to this, so I tell you a story first. I was hosting a money radio show every Tuesday morning for more than 3 years. So practically every week, people will call, SMS. We were getting like 200-300 calls or SMS during the 1 hour show every week. And a lot of the calls and SMS, they all talk about, hey, I invest, how come I lose money? People say they invest, didn't make money after 10 years, didn't make money after 20 years. In fact, I'll tell you why practically there's one stock that most Singaporeans own, never make money for 20 years already, no. But I will give you the name of the stock. Some of you will know already. Okay. So, and then you have people who call the radio show, the listener will say, hey, I lost $2.5 million. This was in 2008. Didn't get a single cent back, you know. Right? $2.5 million money, right? So, because of all this, I kind of try to figure out how to help all these listeners. So I developed what we call Idiot's Investing Guide. Idiot's Investing Guide translate means you must be stupid to lose money investing. Because if you understand, right, how to invest, it's almost impossible to lose money investing. Something must be wrong. But first, let me get back to tell you. Anybody know or not? Which stock in Singapore, after 20 years, the price is still below the IPO price in 1993. Almost, if you say which stock, the most Singaporeans own this stock, this is the one. The answer is, start with S. Singtel. You know Singtel? 1993 IPO, $3.61, right? What is the price now? Okay, 20 years already, still below. So, I have met a lot of people, hey, I invest, didn't make money, lost all the money, or the investment in coma, you know. Now, there's one stock, I wouldn't mention the name, $60 over, then dropped to $2. Then now, you know, it's below $10. Another coma situation, right? You'll be surprised, if you look at history, every 100 stocks or so, over every 100 years, about 30 of them will disappear. No? Either they go bust, or they get delisted, or they get taken to private or whatever. Okay, so these are all the issues that we had on the radio show. So we developed this program. You heard earlier, there's some strange noise going on here. TV, is it? Okay. You heard earlier, I'm past president of the Society of Financial Service Professionals. Every Tuesday morning, we are at the official assignee doing financial counseling for bankrupts. Every week, there are about 30 over new bankrupts. Like you, they will all be seated there because it's a compulsory briefing. Every week, 30 over bankrupts. So 1 year, 2,000 over. You know how many people I've met? I've been volunteering to do financial counseling for 10 over years. You know how many people I've met who go bankrupt because of investing? Too many, okay? Hundreds, if not more than 1,000. So why is it that people lose money investing? You know, it's no fun doing financial counseling. You know why? People come, they talk, sure cry one, no? Some before you start talking already cry. Why? Because bankrupt, nothing left. Then they say, oh, wife run away lah, the son tried to jump down lah. Okay, right. So we developed this Idiot's Investing Guide so that we have less work to do in financial counseling. So people will not, you know, people go bankrupt for various reasons, right? But for people who go bankrupt because of investing, they really must be stupid, because it should not happen at all. Now, why do people lose money investing? Because most people focus on the wrong thing. What do most people focus on? Every time you give a talk, when it comes to Q&A, question time, the questions are always centered around, hey, what is the best thing to invest? Is it this move or that move or that move? Huh? When is the best time to buy the investment? Is it today, next week, next month? And when is the best time to sell? Huh? So everybody is focusing on the returns. And that's why everybody loses money. Why? Because you have to focus on the risk. If you don't understand the risk of investing, if you are making money, it's because you are lucky. Right? You know, practically every year I have an intern from the university. Some, before they graduate, are already bankrupt, you know. Right? Because they go to university, they study a course on investing, they listen to a professor, they come to a talk like this, right? They read, they go internet, they say, wow, okay, investing is very easy, okay? Wrong, because they focus on the returns. You must focus on the risk. So, for a start today, I talk about risk. Where is the safest place to put money? Anyone? Saturday morning, or haven't wake up, is it? Where is the safest place to put money? Huh? In the bank, okay, right? In Singapore, if the bank collapses, what happens to your money? You are protected for 50,000, okay? So, listen to this carefully, yeah? If you have 500,000, please don't put in one bank, okay? You got to put 10 banks, huh? Now, joint account, 2%, 100,000. Now, don't laugh, huh? In the last financial crisis, 2008, the biggest banks, some of the biggest banks in the world died, you know. Some still alive, the name is still there, but actually died already because the government bailed them out. So don't play with this one, right? If it can happen in the past, it can happen again. It's just a bit more inconvenient, right? You have 10 accounts instead of one, or joint account, you have 5. Okay? So, now what is the problem with putting money in the bank? What is the interest rate on a savings account now? 0.1%, right? So at 0.1%, how long will it take for your money to double? You got 10,000 inside, then you put in the bank, saving account. How long you got to wait before the 10,000 double to 20,000? 720 years. Now, even for a fixed deposit today, the rate is only 0.25%. Even if I give you 1% per annum fixed deposit, how long does it take for the money to double? 72 years. What is inflation today in Singapore? 4 point something, right? So the problem with putting money in the bank is the money gets smaller every year. You are losing money, right? So that is the risk, the bigger risk than the 50,000 per bank. You can settle that one, but this one, the inflation risk, the money is very smaller. Everybody suffers. So far, you heard about where's the safest place to put money. Where is the most dangerous place to put money? The most dangerous place to put money are investments that we call unregulated investments in Singapore. What are unregulated investments? You mean got such thing as regulated and unregulated? Unregulated investments means the Monetary Authority of Singapore, MAS, do not regulate these investments. What does that mean? What they sell to you, how they sell to you, who sells it to you, what kind of contract they give you, nobody cares, nobody regulates. So you're on your own. If something goes wrong, you have to go and sue the company, or you report to the Police Commercial Affairs Department if there is fraud. Now, but although it's unregulated, MAS website actually has a investor alert list. If they feel that some of this company has a problem, they put the company's name there now. But a lot of people, of course, when they buy in the first place, they don't know there's such a thing called unregulated investment. Then even if they know, some may not know to go to the website. Even if they go to the website, what normally happens is this: ABC company is on the website. They change the name to XYZ, right? So you can never. So my advice to you is, from a risk perspective, avoid unregulated investments. Every other month you see the big news. You know the gold scandal, the recent one? It's estimated that 20,000 people has lost something like few $100 million. You remember Sunshine Empire? 15,000 people lost $160 million. I have seen people who invest in wine. Then when they want to sell the wine, the company cannot find already. I've seen people invest in art. People invest in boron, in chemicals. You know, I can actually name some of them because the court cases are over it. Profitable plots, boron, right? There's always some new, strange, unregulated investment going on. So, for people who lose all their money in this investment, right, they are stupid lah, right? So avoid unregulated investments. Now, no matter what kind of investment you put, whether regulated or let's say regulated investment, it can be very risky if you borrow money to invest. It's called leverage. You know why a lot of young people I meet, I have seen so many people, 20 years old, they go to official signing bankrupt investing. So I talk to them, what happened? Oh, I'm young, I got 5,000, right? So I buy this investment, 5,000, they let me borrow 100,000 to buy. Oh, when I first started, I was so happy, you know. One day the price go up 5%, oh, I double my money, 100% return. One day the market collapsed, I lost all my money plus all that money, so, you know, I'm bankrupt. Now you must understand that in many of these leveraged investments, people has a false sense of complacency. What I call a false sense? He said, don't worry lah, you have a stop loss lah, right? If the price drop below this level, cut loss already, at the most you lose all your money, right? What's the problem? You will go bankrupt, you owe money. But in real life, sometimes it does not happen like that. In a very volatile market situation, okay? Thousands, tens of thousands, maybe hundreds of thousands of people are cutting loss all over the world. So when you wake up in the morning, say, hey, how come my cut loss, I still lost more than what I put in? That's why whenever there's a huge volatile movement, the next few days you see, a lot of people go to Bodok Reservoir, they don't go home, you know. Right? Because they wake up one morning and say, hey, everything gone, never mind, but still owe money. So, what are some of the risks of investing that you can avoid? Can you avoid the risk of a financial institution failing? 2008, you got money with Lehman Brothers. You watch the news, Lehman Brothers has collapsed. Can you avoid the risk that the financial institution you put money with collapse? Can? Of course. You can totally eliminate the risk of a financial institution failing. And yet, practically everybody I talk to, nobody seems to know this. This is the most basic, the most fundamental thing you must know, right? If a financial institution fails, and you saw in the last financial crisis, the biggest ones in the world can fail. So you avoid, you must ask, is this an investment that is under a category, this category called investments held in trust? So back to the 2008 example, right? Lehman Brothers. Lehman Brothers died. You got money in Lehman Brothers, gone. You got money in the Lehman Brothers structured product, gone. Whatever kind of investment you invest in Lehman Brothers, total loss. But you have money, say, in the Lehman Brothers Unit Trust. Money is safe. Why? This is one category in Singapore where the money is held by a third-party custodian. The money is there. No implications at all if the financial institution collapse. Next example of investments held in trust generally. ILPs, investment-linked products. Same. They are all investment funds. Okay? The money is held in a separate account. ETFs, exchange-traded funds. Also, generally speaking, they are held in custody. Now, when you talk about ETFs, I should warn you that if you are investing in ETFs, even though they are generally investments held in trust, my view is that you must be very careful if you are investing in ETFs that are what we call synthetic ETFs. Synthetic ETFs have what they call counterparties. Now recently, they have an MF global collapse, right? Account frozen, money cannot get back, now say can get back, don't get all the money back. So all these are counterparty problems. Let me explain a bit what you mean by counterparty. Some investments are not real, they are invented by men, right? And then they have counterparties. That means in order to make it work, one financial institution is making a promise to another financial institution that if this happens, when this happens, they will meet the obligation. Now, so far so good, right? But there are so many counterparties going on, like the MF Global case has demonstrated. There may come a day where some of them start failing, then, you know, imagine I'm a financial institution. I give counterparty to other people. Then I take counter people for other people. So there's, you know, everybody is like offering a counterparty agreement to everybody else. So I just want to highlight this to you. Because the thing about investing is, don't think that it cannot happen just because it has never happened. Right? Chances are it will. And what has happened in the past always will happen again. If you think the last crisis, 2006, 2008, was the worst one in the last 60 years, okay, you could get an even bigger crisis in the future. Can you avoid the risk of an investment failing? You buy a stock for a company go bust. Can you avoid that risk? You can't. You buy a bond. We used to say, you study in the textbook, well, government bonds are very safe. So you buy a Greek government bond, what happened? Right? So there is no way to totally eliminate the risk of an investment failing. You can be unlucky, right? Look at Singapore. There were quite a number of cases where they cooked the books, you know. I don't mention the company's name, China Aviation Oil, what have you. Everything is fine. One day you realize the guy cooked the books, then the thing collapsed. Now you cannot eliminate this risk, but what you can do is you can minimize the risk. What do? You diversify now. Can you buy, you have enough money to buy 15 stocks in different sectors? You don't have, right? So the easiest way to diversify, to reduce the risk, is to use an investment fund. You buy an equity investment fund, inside have a few hundred stocks, a few die, what's the problem? You buy a bond fund, 100 bonds inside, a few die, what's the problem? You buy a commodity fund, everything have inside, gold, metals, oil, agriculture, whatever, right? Some of them go down a lot, what's the problem? So, understand this. This is a risk you cannot totally eliminate, but you can reduce. Now, a lot of people say, hey, I buy into a fund, but I still lost money. Yeah, you only diversify within the fund, you didn't diversify globally. So strictly speaking, when you want to minimize your risk, you have to have a globally diversified portfolio of investments. Now I come to the next risk. How do you know that next week, next month, next year, which investment is going to go up, which investment will go down? Anybody know or not? Nobody knows, right? We are all making guesses. Okay? So since you have this risk, how to solve this problem? My suggestion to you is this. Since you don't know what is going up or going down, you buy everything. When you buy everything, now there are 4 major asset classes: stocks, bonds, property, and commodities. Okay? Buy everything means have all of this. You study history, normally when this one go down, that one will more or less go up. They're like, you know, they're like a balance, right? We call this correlation, okay? Because you don't want to buy everything where everything go down, all go down together, right? Then you die, I mean, they all go down, then stay down for a long time, you're finished. So we use diversification. I will not talk about property today because most Singaporeans already too much in property already. Normally you don't have more than 50% of your total assets in property, right? Most Singaporeans like 70, 80, 90, some 100. Hey, you say, why? Property is a very good investment, right? See, the problem is this. You study history, most of the time you focus on the good history, the periods. You know, from 1996 to 2010, in Singapore we had a 14-year bear market in property. So you bought a property in 1996, chances are you have to wait 14 years before the price recover, you know. In fact, from 1996 to 2003, the property market had crashed by almost 50%. You know how many people I met doing financial counseling become bankrupt because of property? Give you an example. You buy a 1 million property, you put 20% down payment, you borrow 80%. The price of the property dropped 20%. What does that mean? 100% loss, right? You put 200,000, drop 20%, you lost 200,000. The price dropped 40%, you have lost 200% of your money, right? The price dropped 50% like 2003 from 1996. You lost 250% of your money. They say, no problem, I hold on, I can hold on, right? Why you lose your job? Why you got paid cut? Why if you fall sick? What if you have accident? You know, all kinds of problems. Then, where you cannot get a tenant. Some people I've seen, 2 months got tenant problem, bankrupt already because cannot service the loan. You know, when you invest in property, you have a foreclosure, that means forced sale. In the 96 to 203 and even 205 period, because the price was so low, when you are forced to sell your property in the, say, mortgagee sale, the sales proceeds minus the loan still owe money. You know what I mean? So it's not just losing your house. You can lose your house, you can lose some or all your CPF, and I've seen people lost house, lost CPF, still not enough to cover the price. Then what happens? Bankrupt also. Then of course, we have seen so many cases. Husband and wife buy, so one person go bankrupt, the other one also bankrupt, right? You buy with children, same problem. So always focus on the risk. Yeah, everybody wants to make money, right? But ask yourself, every year, how many people cannot pay for a house? You know or not? You don't know, right? But roughly, you study history, at its peak, we had about 40,000 households who couldn't pay the HDB mortgage alone. Then you have private housing and all that. So always think about the risk. Okay? So I mentioned earlier, you buy everything, right? How you buy? 40% equities, 40% bonds, 20% commodities. You keep on laughing. Why? I'm saying something very funny. Right? 40, 40, 20. Okay? And within each of the equity or bonds, you must further diversify. For example, you need emerging market equities. Right? You need different regions, Asia, Europe. Bonds, you need different regions, you need different sectors like technology. Okay? So you diversify roughly about 12 funds. Then, more or less, you have, number one, eliminated totally the risk of a financial institution failing. Number two, you have minimized, right, the risk of one investment failing. Why? You have everything all over the world, right? They all have a counterbalance, right? Negative correlation with one another. Now, then the next risk comes. When do you sell? Now, a lot of people fail in this respect. They may make the right decision, they may buy the right investment in the right way, but they also lose money because they don't know when to sell or they sold at the wrong time. When do most people sell their investment? I've been in this profession for 30 over years. Do radio show, do daily column newspaper, do everything. I can tell you from my experience, when you talk to people, most of the time when you really find out when they sell, the answer typically is this. Listen, I sell because every month I see the statement, this one lost so much money so long already, I got heartache, I sell it away. Now, is that the right or wrong decision? It's arguable, right? Nobody knows, isn't it? But let me tell you, the worst way to sell an investment is because you have lost of money, a lot of time, long time, you paid it so much and that's why you sell it away. Don't do that. So, when is the best time to sell investment? I give you a suggestion. The best time to sell is when you need money. You know why? When you need money, you're not trying to guess whether this investment is going to go up or go down. That's why I sell this one and I sell how much. Because your decision is neutral. You are stupid, right? Neutral decision. Don't forget, when you sell something, you think the price is going to drop, right? You think you're smart. Somebody has to buy from you, right? So you think you're smart, that guy must think you're stupid, or you must think that guy is stupid. Otherwise, who will buy from you when you are selling and he's buying? So the fact of the matter is, nobody knows, right? So simple, when you need money, that is the best time to sell. Then what do you sell? You sell the investment that has gone up the most. I mentioned earlier you have 12 different funds, right? After 6 months, you need money. Which one go up the most, sell that one? Right? Always sell the one that go up. Why? Why do we use this strategy? Because Although we say, hey, nobody knows what's going up, what's going down, but one thing we know historically and statistically is this, anything go down a long time, there's a higher chance of coming up. Okay? History, statistics cannot run away one. Anything go up a long time, the more you go up, the longer you go up, the higher chance of coming down, right? So if you understand that all investments historically work like this, when you need money, you sell the one that go up the most. What if you don't need money? Why you never need money all your life? I mean people, no, I forever don't need money. What's the problem? Actually, you don't need money all your life, you have no problem. People lose money, it's a mindset problem. I tell you why. You have, let's say, 10 investments. A lot of people, they say, hey, how come you have some investment go up a lot, you didn't sell? Say, no lah, all the 10 add together still lose money. So I have to wait until all the 10 make money, then I sell. You'll be surprised how many people look at the investment like this, Oh, I put money with A financial institution. All my money, A financial institution must all make money, must be positive, then I will start to think about selling. That is wrong. Right? You need money, you have 2 or 3 of the 10 that make a lot of money, already sell the one away. Then of course a lot of people say, when I need money, I have to send 100,000 to my daughter to study. Then I got money in the bank earning 0.1%. I take the money from the bank to pay lah. What for I go and touch my investment, right? Wrong. Because what go up a lot, long time has a higher chance of coming down. You always use the money in the bank as a mindset problem. All the investment making money, you're not taking profit. So mindset problem, okay? Need money, don't care how much money you have in the bank or in the CPF. Look at your investment, you shall go out the most, sell the most. Okay, take the profit first. But what if you don't need money? Well, not forever lah, but for 10 years don't need money. Then I suggest you can do what we call auto rebalancing. There are some vehicles you can do even free auto rebalancing. What's auto rebalancing? You started with 40, 40, 20, right? After 3 months, wow, the equity go up to 50. What do? You rebalance, bring it back to 40, 40, 20. So auto rebalancing is like taking profit on those that have gone up the most to buy more of those that didn't come up so much or go down. Because you are riding the strategy of history or statistics. You're always selling the one that go up the most to buy more of those that didn't come up so much or went down. And you keep doing that. Let me give you an example. How many of you are retired one here? Oh, so many. Okay. When you're in retirement, what is your concern? You want to have money every month to spend, right? Alright. So this strategy is perfect for you. You put your money in this portfolio. Every month you need say 1,000, 2,000, 3,000. You go in and say, okay, this month I need my 2,000. Which of the 10 go up the most? I sell 2,000. Every month you do that. So every month you are selling the one that are making the most money. Right? In Singapore, we don't have pension funds like the developed countries. You look at all the developed countries, they have pension funds. What do? They collect all the citizens' money, they pay them a pension, right? How can they do that? Same thing, right? Every month they sell investment, then they pay everybody, right? So you don't have that in Singapore. You can do that also. Of course, you have CPF Life. In fact, CPF Life is similar. The minimum sum is 139,000 now. At 65, you get a monthly annuity is about $1,000. Same. The concept is the same. Okay? So you follow these rules, right? Historically, you can't go wrong. Why? Today's talk is not about retirement planning, okay? But we are seeing more and more people have this problem. So let me talk a bit about this. The person is retired, or the person cannot find a job, so he's voluntarily retired himself, right? You need to calculate how much money you need a month when you retire, or because you cannot work already, you don't want to work. How much you need? Roughly, every $1,000 you need a month. Adjust for inflation for 2%. That means every year we increase the inflation by 2%. So first year you draw 1,000, second year you draw $1,020. Keep on compounding lah. Why? Because inflation So you have to calculate that every year you will draw more and more money. Draw until when? Normally we calculate about 88 years old lah. Why? By 88 now, 80% of people die already. Men already, 90% die already. Okay, and most of the studies show you that once you cross like 70 something, you won't spend as much money as you spend when you were 60 something. Why? Because as you get older, anyway, most studies tell you that as you get older, your spending will drop about 15% every 10 years. So there's even you live to 100 is okay in the sense that this kind of automatic adjustment of your needs in retirement. So roughly 5 minutes more. Okay, thank you. 5 minutes more to finish, or 5 minutes including the Q&A. Oh, actually it's including the Q&A. So if I don't stop now, you have no time for Q&A. Never mind, I haven't finished yet. Okay, so this one, roughly every 200,000, and we assume a rate of return of 6%, 2% inflation, you can draw about $1,000 every month, right, for until about 88. Depends. If you retire at 65, you need maybe 180,000. You retire at 55, maybe you need about 220,000. You know. So the later you retire, the less capital you need to put, you know, to draw your this 1,000 using the system that I've just explained to you. Okay. So you know how to invest already. You know how to draw your money already, right? What's next? Q&A. Okay. Thank you. Questions, please. I think we have just a few minutes left. Questions? Anyone? Just raise your hand. Then the microphone will come to you. Right? You know, I'm surprised that we do financial counseling. We see so many people, so many problems. And yet every time you give a talk, you ask questions, don't have. You sure don't have problem? Questions? Anybody? No brave souls today? Yes, can you bring a mic to the young man there?
Can I just ask when is the right time to invest in property? Then is property in Malaysia good or not? Since they're going to build the railway, the high-speed rail.
Everybody have the answer? I mean the question? When is the best time to invest in property? Is it good to invest in Malaysia because going to build railway already? Okay, the answer is nobody knows. Yeah, the answer is nobody knows. But I can make some guesses. Okay. Whether it's property or any other type of investment, stock market, commodities, everything. Okay, there are different ways of investing. Different people have different strategies. My suggestion is I focus on trend. You know what is trend? Look at the moving average and the price, the trend index. If you are buying something to go up and the trend is not bullish, my suggestion is don't buy. You say you invest in stock market, you want to buy the stock go up. If the stock market, the chart is like this one, I won't buy one unless I'm trying to short the market. But generally speaking, it's harder to make money shorting the market than buying it when you're going up. Okay? So if you ask me whether it's property, stock, anything, look at the trend. The trend is up, can consider. Okay. Next, look at the trend. Within the trend, there are so many different things to buy, right? There are 900 stocks. Which stock to buy? Well, same thing. The market trend is up. Make sure the investment, say the stock or the property sector you are buying, the trend is up. Okay. And what drives trend? Price, right? What drives price? Volume, right? Okay. So if the volume is strong relative to other similar investments, if you ask me, that will be the best time to buy lah. But property is a different animal because it's not like you buy today, tomorrow can sell, right? You buy, you got to keep. Okay. So is the trend on property up now or not? Look at the statistics, it's still up. Now, second, you talk about Malaysia and all that, nobody knows lah. But let me tell you this lah. Don't read too much into everything that you read in the news, especially when it's coming to election time. Okay? Malaysia election coming, Come April, the government will have to stop working already. So all types of good news come, okay? Right? So don't put too much into what you hear in the news, especially near the election time. So my suggestion to you is this, okay? Focus on the risk. Because let's take your example. You buy one property in Malaysia. You know how many people bought property in Malaysia, total loss? You ask, in history, the developer collapsed, the condominium nobody take care, then the thing gone, right? So always focus on the risk. Don't think of the return, because all you need to be, you are the one, the unlucky ones where the developer collapsed in Malaysia, you also die. Okay? And next question, anyone? Yes, one mic for the gentleman here.
The current bank interest rate is so low, and you look at the stock exchange at least, the REIT seems to be giving a very good return, and then the risk seems to be quite a low risk because the building is there, the business is going on. Do we advise people to put the money some money from the bank deposit to put in the REIT, like this for REIT?
Okay, the question is, REITs, the yield is quite good, right? 4, 5, 6%. So I take some money from the bank to put in the REITs. Okay. The key to investing is risk, right? And risk is putting all your money in one basket. So you put all your money in the bank, your money is getting smaller every year, right? You don't have a choice. You have to shift some of these to higher risk investments. So risk is one of them. But the simple answer is, you cannot say, I put all my money in risk, because risk also have risk. Now, Invest Fair started, I don't remember, some years ago. I was the very first speaker on the first day of the Invest Fair, right? Talking about risk, I still remember, many years ago, right? You know the risk, when Singapore first started, the risk jumped, right? Then after that they dropped, right? At the worst drop, around, I think 2008, some of the risk dropped like 50–60%. So everything has risk, right? Don't assume that everything don't have risk. So diversify. The key is, okay, you can have some risk, okay, and don't all the same type of risk. So okay, answer your question simply. You want to have some money in risk, okay? So when to buy? Check the STI index. Is it bullish? Not like now. Okay. The chart is up. The moving average, your say 20-day moving average, 3 months is above the trend line. Okay. Then look at the risks. Okay. Don't buy those risks where the trend is down. In my view, because it's like the storm is coming this way, the wave is coming this way. You are running against it. I don't subscribe to this thing. Say, wow, when the thing is dropping by because it's cheap, yeah, you can keep on dropping until you never come up. Okay. So I have the time. Buy, if I'm right, I write the profit. If I'm wrong, I cut loss. Okay? So answer your question, see the REIT that is up, see the volume, right? Volume is strong. Wow, of all the REITs, this REIT today is the second highest in volume. Then the trend is up. Wow, okay, good. Okay? And the best, of course, when the trend is up is when it's a reversal, The guy go down, then he's coming back up, or it's a 52-year high, all that, very technical stuff. But generally speaking, my answer to you is yes. But don't put all your money into risk alone. Okay, time out. Thank you very much.